My goal is to teach you, not to trade for you, not to tell you when to sell, when to buy, or what to buy or sell. My goal is to simply teach you how to trade with the specialist edge. This is the same edge that was able to turn my trading around. Now I'm going to share with you what you're going to be learning today, what I'll be teaching you. But before I do that, I just want to make just a quick announcement. I know a lot of webinars and presentations you've gone to in the past, they like to take questions while the webinar is in place. I'm a little bit different. I like to wait till the very end. So if you have a question, kindly just remember it, and we'll get to it at the very end of the presentation. I have to open up the question and answer box, and I won't even open that up till the end, so I won't be able to see a question if you happen to write it down. The only question I will answer at this point is the most popular and common one, and is this being recorded? Yes, it is. We record all of our presentations. So if you're having technical difficulties or you had to leave early, don't worry, you can contact Pro Trader Strategies and they'll send you a link to this presentation. So once again, if you have a question, kindly wait till the very end of the class. It'll be in about 20 minutes from now. So here's what I'm going to teach you. Here's what you'll be learning today. I'm going to share with you the first component, which is a really simple but powerful technique for trading in sync with the market, regardless of whatever market you decide to trade. Then component number 2 is a price bar pattern. This is a specific price bar pattern you should be looking for in any strategy. And then lastly, I'm going to show you an entry technique. This is a way to fine-tune your entries. Okay, so let's begin. Let's start with component number 1. And obviously component number 1 is you must trade in sync with the trend. Everyone knows this. This is trading 101. We've all been taught to trade in sync with the trend. But if everyone knows this, why do, once again, upwards of 80% of all traders fail? It's my opinion that the reason is because most people have a different idea of what the trend is. I know some educators say that the only way you can find out what the trend is by looking at the higher time frame and making sure it's in sync with the lower time frame. A lot of people use that technique. Other traders say, well, no, you have to look at a specific indicator, some very high convoluted indicator that's been designed, that will tell you what the trend is. Still, other people will look at patterns within the chart to tell you what the trend is. Higher highs, higher lows, and vice versa, okay? They're all okay, they're all valid ways to discern what the trend is, but here is what I feel is the simplest and the most powerful way for determining what the trend is. Let's look at this generic chart, and I specifically didn't put a market on here or the time frame because I want you to know that this applies to any market, any time frame, regardless if this were a 5-minute chart, a tick chart, or a monthly chart. It does not matter. So someone looking at this in hindsight would say, well, Steve, there is no trend here. We're basically just in a range market. We're going down, going back up, and then going back down again. So I've always been taught to stay away from range markets. This is where you get whipsawed. So there's no trend here, okay? That's the way most people would see this chart. That's not true according to what we follow. The easiest and most powerful way to follow and to find out what the trend is to simply add the 50-period moving average, regardless of the time frame, all right? So if this was a 5-minute chart, you would apply a 50-period moving average of the 5-minute chart. If this were a monthly chart, you do the same with monthly bars. Okay, that's all you do. You don't have to look at daily bar and discern what the 50-period moving average is. And then you ask yourself, where is price in relation to the 50? If the majority of price is above the 50, well then the trend is up. And we're only going to be buyers because we only buy if we are in an uptrend. Okay, do you see it's that simple? Now conversely, let's look at this chart here. Same generic chart, another chart I should say, but it's same generic feel here. Once again, someone would say, no trend here, Steve. We're just going sideways. I'm not going to do anything. It's not true. At specialist trading, we always add the 50-period moving average regardless of the time frame or market. This could be a currency pair. It could be a stock. It could be a future. It doesn't matter. And then we ask ourselves, where is price in relation to that? Price is below. So if price is below, are we going to buy anything? No, we're only going to be sellers. All right. So I don't care who says what in a chat room or what signals are generated. If you get a buy signal and it's below the 50 period, don't take it, because over time you will generate nothing but losers. Remember, we're all about consistency. We're not going to say that it doesn't work every once in a while, but over time, if you're buying below the 50 period moving average, you most likely will have more losers than winners, and vice versa. So that's component number 1. Simple, but go back and do some research. You'll see how powerful it is. How about component number 2? Look for a bar that closes in the top 25% of its range. Okay, so what does this mean? Well, if we are above the 50-period moving average, we want to get clues from the market telling us that most likely it's going to take off in that upward direction very soon. So how do we get this clue? Well, we look for a bar that closes in the top 25% of its range. So a lot of people always get confused with this. They go, what do you mean by the top 25% of its range? Well, let's just take this bar, for example. You take the extreme top, in this case it could be the high wick, and then the bottom of the low wick. All right, so that's the range. The range is not from open to close. I don't know, a lot of people for some reason think that's the range. That's just the open to close range, but the true range is the extreme high, extreme low, and you simply divide it by 4. All right, if you close in the top 1/4%, well, that's the top 25%. So we closed here, in actuality we closed in 3 bars. So these bars all close in the top 25% of their range. Now conversely, if we are below the 50-period moving average, we want to look for a bar that closes in the bottom 25% of its range. So we use the same concept. You look at this bar here, we measure from top to bottom, and we just want to see that we close in the bottom 1/4. So this bar qualifies. Remember, this is the market giving us a clue that most likely it's getting ready to take off in the direction it is based on the 50-period moving average. Now, once we have these 2 things in place, we look for some type of way to fine-tune our entries, and therefore we're going to enter upon the confirmation of trend. So what exactly does that mean? I thought we already found the trend with the 50-period moving average. Well, this is our confirmation method. And all it means is that if we are above the 50-period moving average, we're going to buy on the next bar only if price trades 1 to 5 ticks, it's up to you, above the bar that closed in the top 25% of its range. Let me show you what that means. A lot easier, maybe a little wordy here, but a lot easier to understand by looking at the chart. So these are the bars in green that close in the top 25%. This means we're going to buy right here, 1 to 5 ticks above, if we trade there on the very next bar. But remember, we cannot do it if it doesn't happen on the next bar. It has to happen on the next bar, because that way we'll be capturing momentum. So if it doesn't happen on the next bar, we're not going to buy anything. You see, if we use just a standard format of purchasing where we just buy on the close, look what would have happened on the next bar. It would have gone down lower and lower. You probably would have gotten frightened and sold your position, and then the next day it goes right back up again. So what we want to do is wait for confirmation that it trades, not closes, but trades 1 to 5 ticks above. All right, so it didn't do it here. Now we look at the next example, and here it did. You see there, it traded. This is where students have trouble. They say, well, Steve, it didn't close there. It does not have to close. All it has to do is just trade there, intra-bar, and as you can see, it closed lower. But this is an entry point, and look what happened in the next 5 bars. It didn't go up a lot, but it was telling you it's most likely going higher. And we have one last example here. Same thing, closing the top 25% of its range. We are above the 50-period moving average. So we want to buy if we trade here, but on the next bar only. So let's see what happened on the next bar. Well, once again, we traded there. We did not close there. In fact, we closed lower once again, but we're in the trade because the market, not someone on TV or not someone in a chat room, but the market is telling us we're most likely going to be going higher in the next 3 to 5 bars. You may want to jump on board. So taking our cue from the market only, we purchase it, and this time we have a nice gain. See how easy this is when you only listen to the thing you should be listening to, which is the market, not an outside source. How about this example when we're selling? Remember, if we're below the 50, well, now we're going to sell, but on the next bar if price trades 1 to 5 ticks below the bar that closed in the bottom 1/4 of its range. So if we see these examples right here to the downside below the 50-period moving average, here is our bar that closed in the bottom 25% of its range. So we just don't want to sell at the market. We have to wait for confirmation that it trades right here or just intra-bar on the very next bar, and that's our entry. So you can place a stop sell in there. You can just sell at the market once it trades 1 or 3 ticks below. It's up to you. And as you can see, once again, we traded there and closed higher. but we are not concerned with the close. We're only interested in if we trade there. That's our signal from the market telling us we're most likely going lower. So we enter to sell, to go short, and look what happens. You see how simple it is to be in sync with the market when you use these three components. The reason why most people fail is they're overcomplicating their trading and they're relying on someone or something else to tell them what to do. If you learn how to listen to the market, you can make your own trading decisions. And once again, our philosophy is that's how you get on that road to consistency, by making your own trading decisions, not by relying on someone to tell you what to do. So these are the three components that make up probably one of our best strategies. That's strategy number 4. And by best, I mean most consistent. Sure, it does have small winners every once in a while, but it's tremendously consistent in that it's resilient enough to bounce back after it has a small loss. So many times if you have a small loss, you'll make it back within the next 1 or 2 trades. This is strategy number 4, and I just gave you over half of the rules. I believe there's 5 rules in the strategy. I just gave you 3 of them. Okay? Can't give you away, all of them. That wouldn't be fair to the people that paid good money for this strategy, but I just gave you more than half of them. So let's look at some strategy number 4 examples, and I'll show you just exactly how these 3 components were incorporated in all of these setups. All right, let's start out with stocks for all you stock traders. Here's PNW. Okay, the first thing we ask ourselves is, where is price in relation to the 50 period? Price is above. Okay, so this means we're only going to be buyers, right? If it were below the 50, we would not even be considering buying. We would be looking to sell. But since we're above the 50, now we're looking for that bar that closed in the top quarter of its range, and that's this one right here, circled in blue. But we still can't buy it yet. We have to wait to buy 1 or 2 ticks above. And as well, our automatic software generated a buy signal, right? This according to the 2 remaining rules that are in the strategy that I can't divulge at this time. But still, the strategy calls for you, if you want to trade the standard format, to wait for it to trade above on the next bar. If you're an aggressive trader, we give you the discretion to go ahead and purchase it, but you should be trading for a while to have a fairly good insight into the way strategy number 4 works before you trade that aggressively. More conservative traders wait for price to trade 1 to 5 ticks above, and there it did. It traded above on the next bar, so you would have entered roughly around 61.5, and look what happened to the stock in the next week. It went up to 65. How about GRMN? Okay, first thing we ask ourselves is, where is the majority of price in relation to the 50 period moving average? Price is below, except for this brief little spurt we had above. It is below, and there were no setups here that met our requirements, so we're only looking for sell setups. And here's a bar that closes in its bottom 25%. So that's component number 2. Now, the remaining rules of the strategy were met, so our software automatically generated a sell signal. But if you're trading the standard format, we're not going to just sell yet. We have to wait for price to trade right below here, and it has to trade on the next bar. So let's see what happened. As you can see, it did actually trade on the next bar. Kind of a gap down, but you would have been short roughly around the 42 level, 41.5. And what happened in the next month? Went all the way down to 36. So that's a good 4 or 5 points in a month or so. Remember, we're not looking at earnings. We're not looking at news announcements. We're not looking at jobless claims. We don't care about that stuff. Don't let anything determine on what you're going to do. Listen to the market, and your trading will become a lot easier, a lot simpler, and you'll be much more consistent. How about ATVI? Well, we are above the 50 period moving average, and here's a bar that closes in its top 25%. Now I know a lot of you would say, well, Steve, this bar closed in the top 25%, so did this one. Okay, why weren't those buy setups? Well, remember, I can't give you all the other rules. There are 2 more rules that have to be met, and they were not met according to strategy number 4. But guess what? The software automatically generated a buy signal here. So this was a buy signal, and we would enter on the next day, which we did roughly around 26. Now, nothing really seemed to happen for the next 3 or 4 days. We didn't get stopped out, but it was just to show you many times how it may take a little bit longer than 2 or 3 bars to get the momentum going. But provided that you're not stopped out, you remain in the trade, and oftentimes this will happen. Now, obviously, there was some news that came out and that made the stock gap up a couple of points. We didn't know anything about it. No one called us up from the company. The CEO didn't call me up and say, Steve, be sure and generate a buy signal in the stock, ATVI, because we're going to make an announcement and it's going to gap up around 3 points. No one told us that. The only thing we listened to was the market. And the market was telling us, because it's above the 50, because the bar closed in the top quarter of its range, and also because of the other rules in the strategy, that most likely we're going higher. And it did. Here's another example to the downside, XLNX. Now, we are, for all intents and purposes, below the 50-period moving average. We have the bar here circled in red that closes in the bottom 25% of its range, and at the same time, it met all of the rules of strategy number 4. So the software automatically generates a sell signal. But we can't just go short yet. If we're trading the standard format, we have to wait for it to trade below on the next bar only. So we wait to see, and yes, we went short, roughly around 42.5, and the stock goes down to 38.5 in the next week. So you see, this works in upside movement as well as downside movement. Now let's show you how it can work on the E-mini S&P. Let's go to an entirely different market, entirely different time frames, and we'll show you how well it works. Here's the 50-period moving average in green, and where is price in relation to that on this 60-minute chart? Price is below. So are we going to be buying the E-mini on this hourly time frame? Not at all. Remember, it may work every once in a while, but over time, it's like the slot machines. You know, it'll give you this false sense of security thinking that you're doing well, but over time, you really have nothing to show for it. So the main thing is you want to be consistent. So consistency lies in being in sync with the 50-period moving average. So if price is below the way it is here, even if we're looking at an intraday chart, we only want to be short. So here's a bar circled in red that closes in the bottom quarter of its range. At the same time, it meets all the rules of strategy number 4, so the software generates a sell signal. Now, once again, these are the same rules whether we're looking at stocks or futures. But we still can't go short if we're trading the standard format. We have to wait for it to trade 1 or 2 ticks below that bar, and it has to be on the next bar. So as we can see on the very next bar, we got short. So we're short in the trade, and look what happens over the next 2 days. Okay, this was in August when the market fell out of bed. If we recall, the market just was literally down 1,000 points at one day, and all this was signaled in advance by asking ourselves where price was in relation to the 50-period moving average. You see how this will work in your favor. The only people that would have lost in this trade were people trying to look for a bottom and trying to buy. And I'm sure there were a lot of people that tried to buy in these last 2 days. Once again, if you just follow the simple rule of 50-period moving average and listen to the market, you'll have a lot more consistency in your trading, regardless of what strategy you trade. Now, had you missed that trade, don't worry. The beauty of strategy number 4 is that it was always generating signals. So there were 2 more signals generated along the way that you could have gotten involved in. Now that's a 60-minute time frame. Here's the 10-minute time frame. Okay, this is going back a while to July, but I wanted to show you this just to share with you. This is a little bit more advanced trade. Some people have difficulty with this, but coming into the end of this day on this 10-minute chart, we were below the 50-period moving average. At the very last half hour of the day, we actually closed above it 3 bars. So someone would say, well, now the trend has changed. Now we're going to look for buy setups. But on the opening 10-minute bar of the very next day, we opened above and then closed below. And we closed in the bottom 25% of its range. So this is a valid sell signal. Even though the last 3 bars were above the 50, if your entry is below the 50, it's still a valid signal. So it's a little bit more advanced for more aggressive traders. We wouldn't suggest our beginning traders to trade this way, but it's a little bit more advanced, and the strategy add-on generated a sell signal on this 10-minute time frame. So the very first 10 minutes of the day, you had a sell signal, but you have to wait for it to trade below. So you would have gone short right there on the very next 10-minute bar, and look what happened. 20 points in the first hour of trading. That's $1,000 per contract. Now, we're not saying that all of our students stayed in the trade for the next hour for 20 points. I'm sure, had I taken this signal, I probably would have gotten out a lot quicker. But the point is, just to show you, the strength of these signals that come solely from strategy number 4. Now let's go to a 15-minute time frame. All right, we are above the 50 period, so now we're only looking for buy setups. We completely changed time frames. We changed what we're looking at, and now we're in a buy setup. Here's the bar that closed in its top 25%, and the strategy generated a buy signal. So in the first hour of trading, we want to go long on this 15-minute time frame, but we have to trade here, and we did. We entered roughly about 2078, and the market went straight up after that. Okay. Now let's look at some Forex charts, because the same concept applies in the Forex markets. We don't change the rules at all for the market we're trading or the time frame or the direction. Everything stays the same. That's how simple it is. Here's the Swiss franc. We are above the 50-period moving average. We have a bar that closes in the top 25% of its range, so that's component number 1 and 2. The software generates a buy signal, but now we have to go to component number 3. Same exact rule. We want to buy if we trade above that bar. So component number 3 is in place, and we enter the Swiss franc roughly about 9,500, and look what happened. Okay, I know a lot of people trade currency pairs based off economic news and what's happening with interest rates and world conditions. Trust me, after trading 38 years, there's no reason to focus on that. That's very good for investors, and I would be the first one to tell you, if you're investing for the long haul, you need to know what a stock or what currency pairs are going to be doing 5 and 10 years from now. But if you're trading, a couple of weeks, a couple of months, even a couple of minutes, you don't need to know that. It only gets in your way. Trust me, for someone who's been trading 38 years, I stopped looking at news over 30 years ago. Really doesn't pay at all into what we teach. And we can look at a 60-minute chart of the Australian dollar. Once again, this is this more aggressive technique where we are above the 50 period, but then we close below and we close in the bottom range. So it's a valid component of number 2 component. So the software generates a sell signal. Now component number 3, we can only go short if we trade below that, which we do on the very next bar, and then look what happens. Trading is extremely simple when you listen to the market instead of listening to outside sources. So let's recap before we go into questions and answers. Here's what you learned today. Remember, component number 1, you must be in sync with the market, in sync with the trend. Regardless if you're trading 5-minute bars, you're trading monthly bars, you're trading weekly bars, or tick charts. It doesn't matter. You have to be in sync. Some people like to look at a higher time frame, 2 time frames to be in sync together. Other people like to look at tons of indicators, or even other people like to look at different charts, different patterns. Simplest and most powerful way I've learned in over 30 years is just apply the 50-period moving average and ask yourselves, where is price in relation to that moving average? If price is above, you're only looking for buy signals. Okay, that's it. If price is below, you're only going to be involved in sell signals. We are in no way going to be buying below the 50 or selling above. Now, it doesn't matter. You can apply any strategy. You can apply any strategy. It doesn't have to be one of mine. You can apply any technique you're using. But please, that is the simplest and most powerful way to be in sync. And once you're in sync with the trend, once you know which side of the 50-period moving average you are, look for a bar pattern that either closes in the top 25% of its range or the bottom 25% of its range, depending on where you are in relation to the 50. Why are we looking for that? Because the market itself is giving you a great clue. Sometimes it's screaming this clue that it's telling you what it's going to be doing very soon. Okay? Most likely, if you're above the 50-period moving, it's telling you it's going to go straight up, and below, it's telling you it's going to go straight down. So learn how to listen to the market by looking for this particular bar pattern. And then lastly, how do we take advantage of that? Well, I gave you a component number 3, which is our entry technique. We just wait for confirmation, meaning that we want to confirm that we just trade above those bars that close in the top 25% of their range, or trade below those bars that closed in the bottom 25% of the range. And remember, this confirmation, we just needed to trade there. It doesn't have to close there. It doesn't have to close above. We're not interested in the close. All it has to do is just trade there. Okay? Now,